This is InvestTalk. Independent thinking, shared success.
Hi, guys. Great show. I just was wondering about PIMCO Dynamic Income Fund, just as a dividend. I appreciate your advice. Thank you.
So the PIMCO Dynamic Income Fund, it's tough to talk sometimes. Ticker PDI, it's closed-end fund. It essentially what it aims to do is use a dynamic asset allocation strategy across fixed income sectors globally. So corporate debt, mortgage-related debt, other assets. And the goal here is to essentially offer very strong dividend yields. And as of yesterday, the distribution rate was about 15.89% on their NAV. So a dividend yield of about 14.02% on the market price. Now, if you were thinking about, okay, well, the NAV dividend is different from the market price dividend. Why is that? Well, it's trading at a premium, about 13.33% premium, meaning there's a pretty high demand for this fund. And so, overall, it has pretty, exposure as you would expect, right? It's investing in corporate bonds. It's investing in some high yield bonds. It's investing in sovereign debt. Sorry. There's my cat meowing again. And its holdings are about 1,241 holdings across various countries, most of which are focused in the United States. And so when you look at this and you think, okay, the yield here is pretty significant, right? Around 15%. How's its return been over the past year? Well, also pretty solid as well, about 12.88% return on price, 14.45% on NAV. And so, overall, I think you have a dual issue here, right? One is that you're investing in fixed income that is giving you that yield. Another is looking at, well, how are the bonds that they currently own going to change if rates rise? Well, these bond prices, these on the run bonds are likely to go down. And so if you expect the environment to be a rising rate environment, well, then the price of this may go down even as the dividend yield still stays rather beneficial. So that's just something to keep in mind there about any type of fixed income fund, specifically this one. Important to note, though, again, you are paying 13.33% premium to the net asset value of the fund. That's a lot of demand. So for now, I would wait until that premium comes back down way closer to the actual value of the assets the fund holds. That is the PIMCO Dynamic Income Fund, ticker PDI. Now, I hope you know by now, because honestly, if you don't, you just haven't been listening, that we are available, not just in podcast form, but now on our YouTube channel. And while you're over there, if you have a question, you can leave it right there in the comments section, and we will get to that as soon as we possibly can. And this question came in a couple days ago from our friend John Parker 964. It's about ticker TEVA. And it says, what are your thoughts on TEVA, a stock that seems to be re-emerging again from the dead since the opioid lawsuits? The EPS and earnings were good this quarter, and the stock is gaining momentum. Let's take a look at TEVA, which is Teva Pharmaceuticals. Hopefully I am pronouncing that correctly. It is an Israeli multinational pharmaceutical company. They specialize in generic and specialty medicines. A lot of products, 3,500 products all across the board. Earnings, they beat and upgraded in May. So most recent earnings were positive, as John Parker noted. Certainly something positive for the stock there. Debt refinancing has been a big focus for them as well, which is probably something they should be doing because, for a $19.4 billion company, they got about $16.9 billion in debt. A lot of debt for this company, though they have been paying it down from their high of the past 5 years back in 2019 of $26.5 billion. Their cash flow, about as stable can be. Their profitability, not great. Negative. They haven't made money since 2021. The reason why may be because they have a lot of interest to pay on their debt. Now, year to date, they're down 23.87%, down 1.41% on the day. For the past year, they're about flat, only down 18 basis points. And so I'm not seeing a lot that I am liking. They are trading at dirt cheap, forward-looking multiples. Price to books at 3.6. Not that cheap, though. Price to cash was at 7.6. Price to earnings, 6.5. I'm not seeing a lot of improvements. Yeah, they did beat on earnings. They did upgrade on earnings. They did see decent amount of growth there. But overall, I mean, there's still revenue is about the same where it was 6 years ago. Cash flow about the same as where it was in terms of growth. Margin's still negative. They may make money for the first time in quite some time this year, but I don't know. I'm just not seeing a lot to inspire me to enter into this name right now. Maybe it's back from the dead. Maybe it's just moving around and you think it is. Either way, I think I'm going to pass on Teva, however you want to say it, ticker TEVA. Looks like we got a live call. Robert from Pleasanton. How's your day today?
Everything's great. How are you?
I'm doing well, thanks. How can we help you?
So I'd like to get your opinion about VRNA, VRNA. I took a small position in this stock somewhere around a year ago, and that small position has grown a bigger position for sure. It looks like they are like they're going to turn positive on their earnings in their next quarter. I was just wondering what you thought about this company.
Yeah, let's take a look. VRNA Pharma. It's an ADR. It's ticker VRNA. It's a biopharma company headquartered in London with a U.S. presence on the East Coast. It looks like they specialize in developing therapies for respiratory diseases, various products. And one of their main drivers of growth was one of their products which got FDA approval in June of last year for treatment of COPD. Now, one of the reasons why they're doing very well is because, well, their financial performance has been pretty solid. Q1, they reported net revenue of $76.3 million, driven primarily by the $71 million worth of sales from that one product. And so you have this a company that's been very successful on the back of innovation within their business. And with that, right, with that strong performance, they've been upgraded by analysts as well. Now, congratulations again on, or rather for the first time, on having that small position make up a bigger position. And that's because it's up 484% over the past 52 weeks. You know, typically we don't like companies that don't make money. This is headed in the right direction. You caught it when it wasn't making money. And with a lot of these biopharma companies, this is kind of how it goes, right? A lot of them are unsuccessful. Every now and then, some are successful. It's still trading about 144 times price to forward-looking earnings, but that's primarily because of the negative margins we see here. But price to book is at 27.3. You know, it's up another 3% today. It's up 60% year to date. You had a big win here. I think what you should really do is start to trim out of it, because even though it may start to make money this upcoming year, right, in December 25, it's projected to have a net margin of about 6.6%. It's still trading very, very expensive from the joy of fantastic earnings, from the joy of a product that's working. I think this is a good opportunity to start to take profits. But in a way, you're playing with a lot of house money here, so I don't see any problem with keeping a little bit invested in this name. But anytime you get a big gain, good to start to take some profits. Thanks for the call.
Stay informed with exclusive insights by subscribing to the KPP Premium newsletter today.
Hello. First off, I want to say thank you guys for putting out a wonderful show. I get a lot of knowledge from your show. But my question is, I'm 46 years old. I've got a fair amount of stocks, but I've also got a decent amount of credit card debt. And I'm trying to chop away at my credit card debt. Do you think it would be wise to pull out my stocks, pay off my credit card debt, chop up my credit cards, and never use them again, and then start building my portfolio? I know the interest is costing me more than the interest I'm making on most of my stocks. So if you could answer that question, I would be grateful. I hope you have a great day. And again, thank you for the show.
Well, I think you answered the question for yourself. You said that the interest that it's costing you towards these cards is more than what you're making in the market. And that's because credit card debt in particular can create a stranglehold on your finances. And that's because the interest rates are so astronomically high. Generally speaking, when you're thinking about the debt picture in terms of, do I want to pay this off? Do I want to pay it off over time? Credit cards are always, unless it's an introductory offer or something that's particularly low, one of those things you should pay off. It can be in the 20%, the 30%. But generally, the math comes down to, can you make more investing elsewhere than paying this off early? Here's the example. Say you have an auto loan. Say you have a mortgage. Say you're lucky enough to have one of those 3% mortgages. If you have the money to pay that all off today, should you do it? Or should you invest it? You could put it in SGUF. You put it in a money market fund. You can make more than that 3%. And so you'd put the money in the money market fund. You'd make your 4.5%. You'd do the monthly payments. At the end of the day, you'd end up with positive money compared to just paying it off right then and there. That's not the case with credit cards. So what you should do is do all you can to pay off those credit cards. Then, once you're in a position where the debt is not accumulating greater than the returns you're getting in the market, start to put money back in the market. Thanks for the call. Now, we already tackled one, so let's tackle another. This question from the InvestTalk YouTube channel from our friend Dean Harper, and it's on when comparing ETFs. Question mark. It says, when comparing ETFs utilizing Schwab, tip ranks, etc., does the performance comparison chart factor in the expense ratio into the calculation, or is this a calculation you have to make yourself? Well, here's the thing. It depends how it's reported. Okay, so let's take a random ETF here, typing in, not making any comments on if this is a good ETF or not a good ETF, but you're looking right here at this performance chart, and what you're seeing here is price. So this is the price return, this is an NAV return, but oftentimes what you should be looking at is a chart where it'll say whether or not you're looking at gross or net of fees. And so anytime you're looking at reporting, you should be looking for net of fees, because this net of fee total return, right? So not just price return, but net of fee total return is going to show you if I held this stock for a given period, what would the price appreciation plus the distributions I'm getting be after the cost of fees? So there's the advice there. Any data source you're looking for, always look for net return, not at gross. Thanks for the question. As we mentioned at the top of the show, as we mentioned in the market wrap, there has been recently a lot of focus on that one big beautiful bill, which is the name that the president has given the proposal for spending and for renewing the Tax Cuts and Jobs Act of 2017? Yeah, 2017. Now, while this bill has been discussed, there's also was, over the weekend or Friday afternoon, I guess, after the market closed, Moody's downgrade of the U.S. credit outlook, citing the deterioration of our fiscal position, which has since pushed the 30-year Treasury yield to, what's the 30-year at right now? Just under 5%. Now, the Nonpartisan Committee for Responsible Federal Budget estimates this bill, that one big, beautiful bill, would add at least $3.3 trillion to the national debt by 2034, raising the debt to GDP ratio to 125%. Now, the White House claims that there would not add to the deficit because growth would offset that. Well, if you look back to the 2017 tax cuts, that actually didn't end up happening. But the reality is, and I looked into this today, that the general consensus around the cost of this bill to government debt is probably underselling it. The CBO, Congressional Budget Office, looked at this, that $3 to $4 trillion estimate. Was it about a yield, 30-year yield of like 3.5%? We're sitting under 5 now. It is becoming increasingly difficult, and it's putting us in an increasingly difficult position, the fact that our debt is so large, such that the interest payments on it are becoming so large, nearly $1 trillion in interest. And so with this, right, you saw equity markets being floated by what's happened in the wake of Liberation Day, the rolling back of some of the more dramatic, shall we say, policy choices. But the bond market is still signaling that there are issues here. Investors are increasingly demanding higher returns to finance U.S. borrowing. to the point where people are saying, okay, Fed cut rates. Does it even move the market at this point? Investors like Ray Dalio, Bill Campbell, they're warning about the market fallout if the US fails to rein in deficits, which again is becoming increasingly unlikely, hence the ratings downgrade. And so bond vigilantes are likely to continue to mount pressure. One of the benefits of having a high credit rating, of being so important within the financial structure of the globe is something that we've talked about, right? It's the exorbitant privilege that the US dollar affords the United States. It is unlikely that any other country on earth that doesn't use the dollar could finance this level of debt at these interest rates. But here's the thing. Look at where yields are soaring. The bond market is starting to lose faith in the US's ability to manage its massive deficit. And so it'll be interesting to see, it'll be critical to see. There are a lot of holdouts in the House. There are certainly some people that are not for adding this amount of debt in the Senate as well. But either way, the warning signs are flashing. We are setting a course for the next decade. Where will that take us? Now let's keep things moving. Get back to the voice bank for a question that came in earlier on 888 and 99 chart.
This is Colin in Denver, longtime listener. Love the show. Thank you very much. Wondering what you guys think about CTRA Energy. That's CTRA. I have a long position that I've held for a while. Just wondering what you guys think about it in the short and long term. Thank you very much. I'll listen for the answer on the podcast.
CTRA Energy, that is ticker CTRA, is a $16.7 billion market cap company. Pays about a 3.51% dividend yield and has, only about $4.5 billion in debt. Now, it engages in exploration and production of oil, natural gas liquids. And so it's fairly well diversified here, right? About 54% of its revenue comes from oil. Another 31% comes from natural gas, 14% from NGLs. That's pretty solid diversification here. Now, over the past 52 weeks, it's down about 12.49%, underperforming the industry benchmark only by 10 basis points. So I'd say pretty static there. Again, because oil hasn't been doing well, a lot of natural gas names have. In terms of how it's trading about 8.4 times forward-looking earnings, just below its average 1.3 times price to book value. Again, it doesn't have much debt. Its balance sheet looks fine. Its cash flow, its financial performance hasn't been remarkable. Its margins have slipped from a high of 42 in December of 2022 down to about 20%, but it's primarily going to be because of the line of business that it's in. Now, it did announce a 30% reduction in its position in the Permian Basin. Certainly the market did not like that. But it did beat analyst expectations and did get a little bit of an earnings upgrade going forward. And so for this name, I think it has a pretty good diversification in terms of the commodities that it is doing business with, right? Oil, natural gas. Companies that are 80% in oil have been suffering a lot more with the price of oil. And so if you're looking for a company that has pretty solid growth potential, right? Its revenue growth has been 23.4% on an annualized basis going back the past 5-6 years, trading pretty cheap at a time when oil's not doing too hot and keeping prices depressed. Well, this company's only down 2.58% year to date. It's had a solid performance track record. Its financial performance looks good. I'm going to give it a thumbs up. If you're a long-term investor, companies like CTRA Energy, when oil is down, good place to buy. Thanks for the call. You know what? Let's play 2 in a row.
Hey guys, Adam again from Texas. I was calling to see what you thought about Cloudflare. The ticker symbol is NET, November Echo Tango. I was just curious to see what you thought. Thanks. Bye.
Cloudflare is a tech company. Specifically, it's an internet infrastructure company. It's got about $64 billion market cap, does not pay a dividend yield at all, and it is up 108%. 108% in the past 52 weeks. In terms of debt, not much to speak of, about $1.4 billion worth of debt. It has not made money before, but it is projected to make about 13.8% in terms of net margin this year, $290 million in net income on about $2 billion in revenue. Pretty decent margins. Sales growth, 42.2% over the past 5 years. This platform operates on and enhances the security of over 19% of all websites globally. So Cloudflare, tough one to say 10 times fast, has done a good job of penetrating a market that is pretty important, right, in the 21st century. And because of that, it's had significant growth. Very robust Q1 results and earnings upgrades on the back of that. And so this is a situation where you got a company that is on the upswing, it's capturing market share, it's growing, it's finally going to potentially make money, but it's also really, really expensive. 120 times price to cash flow, 30 times sales. I'm not saying those margins aren't justified, but those margins are pretty risky. If we have some more testing to the downside, these are the types of names that potentially stand to suffer. I would keep it on my watch list because, again, 20% capture of global internet security traffic. Pretty solid, but still very expensive. That is ticker NET, Cloudflare Inc. All right, let's talk a little bit about Japan. Yields on Japan's 30 and 40-year government bonds surged to record highs today, hitting 3.14% and 3.61% respectively. The 20-year bond yield also jumped to 256. Now, the sell-off was driven by, say, concerns of the Bank of Japan's bond tapering, the massive, the response to the massive debt that they have, over 200% of GDP, but also to external risks about U.S. trade and what it might mean if Japanese investors start to repatriate capital back, specifically for global assets. And one of the things suggested, halting the issuance of long-dated bonds to contain and calm amongst this market volatility. Now, some stakeholders are urging there to be a pause in the super long-dated tapering, so to avoid further dislocations of the yield curve. But the reason why I brought this up is because this is another country where it has a unsustainable path of debt. Where they had a remarkably strong market, where they were spending way too much, where they put themselves in a position where they had to jam debt down everyone's throat, public-private sector, crowd out investment, and growth is stymied for 30 years. And so this is an important story, not just because of the role it plays in terms of capitalizing investment globally, the carry trade is what I'm referring to, but maybe a warning shot. So pay attention.
Discover more valuable information at InvestTalk.com.
It's Steven from Texas. Just curious what you guys think of ticker symbol O, Realty Income Corp. I had it in my phone as a stock to watch, but you could let me know what you feel like a good value for it is and a good entry price. Appreciate it. Thanks. Bye.
Realty Income Corp, that is ticker O, is pretty large, I would say. REIT, about $50 billion. It's founded in 1969 in San Diego. They own 15,600 properties across the US and Europe, leased to approximately 1,600 clients. So when I hear nearly 16,000 properties and 1,600 clients, that's some pretty solid diversity there, and it's across the board. Look at this: retail, industrial, office, agriculture. No, a lot of it focuses in retail, meaning, well, maybe if retail businesses aren't doing well, leaseholders are defaulting, that can certainly be an issue there. But most of the difference in terms of its strength, its relative performance, going back to 2019, is really what happened during the pandemic. Now, in 2023 and 2024, it did underperform the industry broadly. In 2025, it is outperforming by about 4.2%. But revenue growth looks really solid. Income growth looks solid as well. And the thing that I think most people like about this company is the amount of times it has consistently paid its monthly dividend. As of May, Realty Income announced its 659th consecutive monthly dividend. And so for most REIT investors who are not necessarily looking for huge capital appreciation, again, this is a real big guy, but are looking for that consistent dividend, this is the company that does it. Its dividend yield sits about 5.7% right now. It's been anywhere between 3.8 and 6 over the past 6 years. But in each of those years, every month, it has paid out a dividend. Quarterly performance looked solid. Net income, about $249 million. They did beat estimates. They did increase their guidance as well, heading into the end of the year. So if this is the type of thing you're looking for, solid, consistent dividends, pretty broad, diversified real estate exposure, keeping in mind maybe some headwinds out there related to retail. Realty Income Corporation, ticker O, always a solid dividend play. Now, before we head off for the day, I wanted to briefly touch on news that 21 Republican state financial officers have urged the SEC to delist Chinese companies, or rather assess whether they need to delist Chinese companies. And so Chinese companies are sometimes registered as ADRs, American Depository Receipts, but there's also issues with a specific structure, the Variable Interest Entity, VIE, which essentially sidesteps a lot of direct regulatory scrutiny while still getting some of that US capital. And so this letter also follows a recent push in the wake of the trade war from the House and the Senate, Republican leaders, that specifically named Alibaba and others as national security risks. And so with this, coupled with lowering of the potential tariffs and giving a 90-day pause, there's kind of a juxtaposition here. Do we want a strong arm? Do we want to talk? Now, certainly this is an important issue for the new SEC chair, only 30 days into his tenure. But Gary Gensler before him increased scrutiny on Chinese firms. I think overall the goal, the mission of the SEC is to protect investors from unscrupulous, unethical, illegal behavior. And so as much as the Chinese companies are using loopholes to skirt scrutiny that other companies are subject to, certainly I think giving them a second look is a good idea. I'm Lou Guerrero. This completes another InvestTalk program. We thank you for listening, Justin and I, and we encourage you to tell your friends and family members about our free podcast downloads. And if you want to check out our YouTube, guess what? My cat joined us today for our market wrap-up. Go check it out. If today's show made you think about your own financial picture, your investments, your taxes, your retirement, whether it's all really working, let's talk. At KPP, we offer no-cost portfolio reviews to help bring clarity and confidence. Just go to investtalk.com and click on the portfolio review button. Independent thinking, shared success. This is InvestTalk. Good night.